Hello. In this video, we will learn about PV and other related financial functions in Excel.
Excel has a set of time value of money functions like PV for present value function, FV for future value function, PMT for payment function, and rate function to find the rate, and NPER function to find the number of payments. So all of these are basically based on the time value of money formula. Future value equals present value into 1 plus r to the power n. So the first function, present value or PV function, is basically it returns the present value of an investment or a loan amount. So when you use the present value function, you get the value in today's dollars or today's currency of a set of future payments. Here we are assuming periodic and constant payments and a constant interest rate. So the syntax of the PV function is rate, NPER, PMT, future value, and type. The rate is basically the interest rate per period. If the periods are monthly, you need to basically divide the annual rate by 12 to get the monthly rate. The NPER is the number of payments. So if it's like a 5-year loan, you have 5 into 12, 60 periods. PMT, the payment, is the amount you pay monthly or periodically, and it's the same amount. You can't change it during the life of the annuity. And we have a cash flow convention. Cash paid out is a negative number and cash received is a positive number. If you don't give the PMT, optional future value argument must be supplied. The future value is again optional. This is the cash balance after all payments have been made. When future value is not included, it defaults to 0 and PMT must be supplied. The type again is optional. Type basically denotes whether the cash flow is due at the end of the period like regular annuities, and is one for payments due at end of the period like annuities due, and it defaults to 0, that means end of the period. And we have the cash flow convention for PMT and future value. Money received is positive and money paid out is negative. So let's look at example. We got interest rate per year of 6%. So we want to find the present value of 5 payments of $1,000 each paid at the end of each year. So we can write the function equals PV for present value, and the rate is 6%, and then the number of payments is we are having 5 payments. We put 5, and the PMT or the payment is $1,000, and it's always negative, so we put 1,000. And then future value we are not going to have a cash flow at the future, so we put 0 there. And then the type is end of the period cash flows, so we can use 0 as the type. And we press enter and we get 4,212 and 36. And we have another cash flow series. 5 payments of $1,000 paid at the beginning of each year. So we want to find the present value. So here the difference is cash flow is beginning of the year. Here it was end of the year. So let's do the function equals PV present value, same rate. Then number of payments again 5. And PMT is minus 1,000 again. And here present future value 0. And here we are going to select beginning of the period or option 1 for the type. And we press enter and we get 4,465. So it's more here because we are paying at beginning of the year and it has more time to compound and add to the value. So here it was end of the year, and here we have an additional year of interest that comes. So that's why we get 4,465, which is higher than the end of the year payment total. Then we have another cash flow where we got 5 payments again, $1,000 each, end of the year. We get an additional £500 paid at the end of year 5. So we write the function here equals percent value, PV, and the rate is 6, and number of payments 5, and PMT is minus 1,000 again. And here we have a future cash flow. So we got 500 additional payment at end of year 5. So that we have to put as a negative value, minus 500. Because it's cash, because the cash is going out, it's a negative value. And then end of the period, so we put 0 and we press send. So we got 4,585 as the present value here. And here we got 4,212. So both cash flows are same, except there was a £500 at the end of year 5. So this is greater than this value. The future value function is the opposite of the present value function. Here we are calculating the future value of a investment. Here again we are assuming periodic constant payments with a constant interest rate. The function is similar in syntax to present value. So here difference is we are having future value here, FV, and here we are having PV here for present value. So rate, number of payments, PMT, present value is there, and then the type is also similar to the present value function. So let's look at an example where we are going to invest $1,000 per year for 30 years at the end of each year at a 6% rate, and we want to find the return that will be available for retirement when this person retires. So we can write the function equals future value FV, and the rate is, we can type 6%, or we can put 0.06, and then the number of payments is 30 years, so 30, and we are going to have a PMT of 1,000, so minus 1,000 there, or as PMT is negative, and then we are going to have, we don't have a cash flow at the present, so it's 0, and then the type is going to be end of the year, so 0, and we enter, and we get $79,058. So again, if we are using the same example, here we did end of each year. So here we will do beginning of each year and see what the retirement fund will be. So let's do the function here, equals FV, the rate is 0.06 or 6%, and number of payments 30, and PMT is 30 payments, and the payment is minus 1,000, and present value is 0, and here we are going to have beginning of the period, so 1, and we get 83,000, which is higher than the 79,000 we got for end of the year cash flows, and beginning of the year, since we are paying cash early, we got more time to earn interest. So we get 83, which is higher than the 79,000. Then let's look at this final example. Here we are going to invest $10,000 initially at the beginning and then $1,000 for 30 years, end of the year, or at 6%. So let's see the retirement fund on that situation. So equals future value. The rate is again 6%. Number of payments 30. And PMT is minus 1,000 again. And here we got a present value because we are initially investing 10,000. We put in as negative 10,000 because money is going out. Cash convention is negative then. And then it's end of the period. So you put 0 and enter. So here we get 136,493 because we started off with initial 10,000 investment, which compounds for 30 years at 6%. We can use the PMT function to calculate the periodic payments like on a loan or a lease, the equated monthly payment, assuming constant payments and constant interest rate. So the syntax is this: PMT, we give the rate, NP, number of payments, present value, PV is the present value or total value of all the loan payments in current terms. Then we have future value, which is optional. It is the cash balance after your last payment is made. So this defaults to 0. So if you do a balloon loan where you have a final payment, let's say $1,000, then the future value is minus 1,000 because we are paying that 1,000 at the end of the period. And it's negative because it's a cash outflow. The type is optional. Again, it's the same convention like PV and FV function. So when payments are due, end of the period, we use 0 and 1 for beginning of the period. And the default is 0 or end of the period payments. So we have one loan here. We are borrowing $10,000 and it's for 18 months. And the interest rate is 6.5%. So we can calculate the monthly payment or loan installment using the PMT function. So let's type the function equals PMT. The rate is 6.5% per year. So we divide that by 12 to get the monthly rate. And NPER is the number of payments. So we got 18 months. And the present value is the amount we are going to borrow. That is 10,000. And future value is going to be 0 because we are not going to have any balance at the end. And the type is end of the period. So we put 0 and enter. So and we get a negative value here because by convention PMT is always negative because it's taken as a cash outflow, as like a loan payment paying out. So we need to put a minus in front to make it positive. So we get $584.58. That is the monthly installment on this 10,000 loan for 18 months at 6.5% annual interest rate. So we look at another example here, similar cash flows and the loan amount, except we have a final balloon payment of $1,000 at end of the loan tenor on the 18th month. So we can calculate the PMT using PMT function. So we'll start with the minus PMT and the rate is 6.5 divided by 12, and number of payments is 18, and present value is 10,000, and future value is, in this situation, we have 1,000 balloon payment at the end. So you put that as outflow minus, and then this cell is linked to that for the minus 1,000. And these are end of the period, so we use 0 and we press enter. So now the loan installment is $531.54. So it has reduced from this amount because we have a final balloon payment of 1,000 as well. So it's reducing from the capital. So we have less interest we had to pay. So we got monthly installment of 531, which is lower than the 584 because of the balloon payment. We can build a loan amortization schedule where we get the breakdown of each of the monthly payments into principal and the interest payments by using the Excel's time value of money functions. So here we got a loan. We are going to borrow $10,000 for 18 months and at 6.5% interest rate. So we can first calculate the loan installment using the PMT function. So equals, we put a minus PMT, and then the rate is 6.5% divided by 12, and the number of payments is 18, and the present value is the loan amount 10,000, and future value we are not going to have anything, it's going to be 0, and then the type, it's end of the period, so 0. So we got $584.58 as the loan installment we have to pay monthly. So we got a kind of a template here we can use to build the loan amortization schedule. So the beginning balance, we can link it to the loan amount from here. And the monthly payment, I can link it to this cell. And I can fix it using F4 to put the dollars because monthly installment is always the same. So we got monthly installment. And now I need to break down the principal payment in this loan installment. So I can use, there's a function called PPMT or principal payment to do that. So I can type equals, and I had to put a minus here because the function always returns a negative value like the PMT. And the function is PPMT for principal payment. And the arguments are rate, where is the installment number, and NPER is the number of payments. Present value is the loan amount, and future value is the future value at the end of the loan. So here that's going to be 0, and type is the whether it's a beginning of the month or end of the month. So for the rate, we can use 6.5% divided by 12. And since I'm going to copy it down, I need to fix C7 using F4 to add the dollars, and then the installment number, the per, I can use this cell to link there, B13. Number of payments is 18. I can link it to that cell. Then I will need to fix that. So I'm going to copy it down. So I press F4 there. The B13, the per, I will not be fixing because I want to move it when I copy it down. But this one I need to fix using the dollars. And then the present value is the loan amount, C5. So I need to fix that also because I'm going to copy it down. So I press F4 and come up, and then the future value is going to be 0 and it's going to be end of the period. So 0. And I get principal is $530.41. So out of this monthly payment, $530.41 is the principal or the capital. So we can calculate the interest payment also. For this, we have a similar function to PPMT. It's called IPMT, interest payment. Same syntax. So we can use that here, equals. Again, we have to put minus IPMT for interest payment. And the rate, again, is going to be 6.5 divided by 12. And I need to fix this using 4. And is the pay installment number. I can link it to this cell. And number of payments is 18. And I need to fix that. And then the present value is the loan amount, 10,000. I need to fix that, F4. And then future value is going to be 0. And type is going to be 0. And I can press enter. So I get $54.17. It's the interest component in this installment. So if I add these together, if I highlight this, I can check in the status bar, the total sum is $584.58, which is equal to the monthly installment. So that's correct. So I can also calculate on first principles this interest payment by doing this formula equals. We start with the loan amount and multiply by the interest rate, and we had to divide the interest rate by 12 to get the monthly interest rate. And I get 54.17. So it's the same answer that we get if we calculate using first principles. If I didn't know the PPMT function and the IPMT, I can still calculate the interest using first principles like this. And to get the capital or the principal, I can reduce from the monthly payment the interest that I calculated over here. So I get 530 and 41. That is the principal or the capital. So it's much more easier because we have the functions ready-made. We can use principal payment and IPMT to calculate. So the ending balance will be the beginning balance minus the principal component, and I get 9,469 and 59 as the balance. So on the second row, I need to start this ending balance as the beginning balance, and I can copy this down. Monthly payment is going to be same, and principal payment I can copy it down, and the interest payment I can copy it down. So again, these are calculated. So the ending balance also I can copy it down like this. So once I have copied to the second row, I can copy down to the whole range, and I get my loan amortization schedule. So here you can see the ending balance capital principal has become 0. So our calculations have been correct. So loan has basically reduced to 0 by end of the loan tenure. So this is how we can do a loan amortization schedule. And we also have two other functions, the cumulative principal function and the cumulative IPMT, or the cumulative interest payment function. So this calculates the cumulative principal, and this calculates the cumulative interest payments. So it basically computes the principal paid between two periods, inclusive of those two periods. For example, if I want to calculate the principal paid from first to the fifth installment. So here I have the first installment and up to 5. If I want to calculate the total of this principal payments, I can use the cumulative principal function. I can type the function here to calculate the cumulative principal equals, and we start with a minus because the value comes as a negative value, cumulative principal, and we need to select the rate is 6.5 divided by 12, and then we got the number of payments, which is 18, and the present value is the loan amount, 10,000, and the starting period I can give 5, starting period I can give 1, and the ending period is installment number 5, so I could put 5 there, and then the payment type is end of the period, so I can put 0. So I can then enter the formula, and I get 2,680 and 96. So if I check these 1, 2, 3, 4, 5, I get the same total on the status bar. Sum is 2,680 and 96. So it's correct. So I have the similar function to calculate the cumulative interest payments. So I can try that for, let's say, 5th to the 10th installments. So I can type the formula equals, same syntax, minus cumulative. Here we are going to go for cumulative interest payment, IPMT. And the rate is 6.5 divided by 12. And the number of payments is 18 again. And then we got the present value loan amount, 10,000. And the starting period, we want to calculate from 5th to 10th. So 5 is the starting period. And the ending period is 10. And it's end of the period. So we put 0 there. And press enter. So we got 211 and 13 cents. That's from 5th to 10th. So let's check that. 1, 2, 3, 4, 5. From here to 10. So this total is 211 and 13, which is the same answer we got using the function. So that is correct. Now let's look at the rate function. The rate function basically helps us to find the interest rate that is inherent in an annuity. Basically, the effective interest rate on an annuity can be found using the rate function. And it calculates by iteration. That means by trying different values until we get the correct rate. So again, the rate function calculates the periodic interest rate like monthly. Then we have to multiply by as required to derive the annual interest rates. If we get is a monthly rate, we have to multiply by 12 to get the annual interest rate. So here the syntax is NPER, number of payments. These are all arguments are similar to the functions we did earlier. PMT is the monthly payment, present value, future value, type, whether it's end of the year, end of the period, or beginning of the period. And we got an optional argument called guess or the guesstimate, which is optional. So most of the time you don't have to basically use that. You can leave it blank and then it will default to 10% or 0.1. So let's take this example. We got a loan of 10,000, 10 of 18 months, and 584.58 is the monthly installment. So we want to, let's say, infer the interest rate, effective rate in this loan. So we can write the function equals rate, and then we have to give the number of payments 18, and PMT is the monthly payment. So the monthly payment we have to give as a negative value, say 20, and present value is the loan amount, 10,000, and future value is 0, and the type is end of the period, and the guesstimate we don't have to really put that, so I leave that blank and I will press enter, and I get 0.5%. So this is actually the monthly rate. So to get the annual rate, I will need to multiply this by 12. So I'll need to change the formatting here. And I get 6.5% as the effective annual interest rate. So which is the same example we did here. So we applied 6.5% and got the monthly payment of 584.58. So it's the same example. So the interest rate is correct. 6.5% is the effective interest rate in this loan. Then we have a function called NPER function. NPER basically returns the number of periods in a loan or investment. So it's basically deriving the number of period that's inherent in a loan amount and at a given interest rate with a certain installment amount or payment amount. So the syntax is rate, PMT, present value, future value, and then there's the type for the payments due and end of the period and beginning of the period options are there. So all of the arguments are basically the same that we have used in the other time value functions. So here let's look at example. We got a loan, 10,000. Loan installment is 584.58 and interest rate is 6.5%. We want to find what is the tenor of the loan. So basically we are giving the other variables and deriving the missing variable, which is the loan tenor. So let's type the formula equals NPER, and then we have to give the rate. So this is the annual rate. We divide that by 12, and then PMT is again minus this value, and the present value is the loan amount, and future value is 0, and the type is 0. I can press enter and I get 18 months. So this is the same example we used earlier in other example. So 18 is the correct tenor. So number of payments we got 18. So that is correct. So let's look at another example. Here, if I borrow 100,000 at 7% interest and make installments payments of 10,000 per year, how many years will it take for me to pay back the loan? So basically I'm giving a fixed payment amount, and then I want to find out how long will it take. This is the amount I can afford to pay. So how long will it take for me to pay at this interest rate for this loan amount? So we can use the NPER function to calculate this as well. So we can type equals NPER function, and then the rate we are going to have 7%. So we can put, so these are annual payments, so I can just put 0.07 or type in 7%. And the PMT is going to be 10,000, so I put negative 10,000. And then present value is the loan amount, 100,000. And future value is 0. And it's end of the period, so 0. And I can press enter. And I find I it will take about 17.79 years, or roughly 18. It will take me 18 years to pay this loan off. So if I want to calculate X in months, so there is 17 years here. So if I deduct from here 17, this is the fraction of a year that I have, 0.79. So if I take 12 months and multiply by 0.79, so that's about 9.5 months. So it will take me 7 years. So it will take me 17 years and 9.5 months to pay off the loan.
Thanks for watching.